Are you uncertain whether your business entity structure is best? Well, there are basically four types of entity structures, and today I'm going to discuss the highlights of each of them. And then I'm going to end by discussing which entity structure is best. Welcome. For those of you who are new to me, my name is Lisa Marie McAllister of Pinnacle Financial, and I help real estate investors who fix and flip residential properties to obtain funding and to save on average $30,000 annually through strategic business and tax planning. Now, I am both a CPA and an enrolled agent. And before we get started, I ask that if you like this video, to please share it, click on the like button, and also hit the subscribe button. That way you will be notified when I upload new content. Now let's get started. The four entity structures that I'm going to discuss today is the sole proprietorship, the general partnership, corporations, and LLCs. Let's start with the sole proprietorship first. Now, many businesses begin as a sole proprietorship and they graduate to a more complex business structure as the business develops. Now, this entity structure is comprised of one business owner, and the tax law refers to this entity structure as a disregarded entity. In other words, it is not a separate entity from its business owner. This entity structure, unfortunately, is subject to unlimited personal liability. And it does, if this business owner is married, the risk does extend to the marital assets. So, unfortunately, this business owner is liable for the debts of the business. This entity structure, the sole proprietor reports its share, it reports its profits or its losses on its Schedule C of their personal tax return. And unfortunately, it is subject to the hefty self-employment tax of 15.3% on all of the earnings. So that concludes the sole proprietorship. Let's move on to the general partnership. The general partnership in many aspects is very similar to the sole proprietorship. This entity structure is comprised of two or more owners, and it is a pass-through entity structure, meaning the profits and losses pass through to the business owner. Like the sole proprietorship, it is subject to the unlimited personal liability. The partner is taxed on its share of the profits or losses on their personal tax return, and like the sole proprietorship, is subject to the 15.3% self-employment tax. Next, let's move on to corporations. Now, there are basically two forms of corporations. You have the C corporation and you have the S corporation. Let's discuss the C corporation first. Your large publicly traded companies are generally your C corporations. And unlike the previously discussed entity structures, it is considered a distinct legal entity. In fact, it's seen as a person. It can sue and be sued. It can buy property and sell property. It is taxed, and it can also commit crimes. Now, one of the advantages of this entity structure is that it does provide personal liability protection for its shareholders. And also, this entity structure does tend to be eligible for more tax deductions than some of the previously discussed entity structures. However, there is a downside, and it's a big one, and that is what you've maybe heard: double taxation. So when the corporate earns profits, it is taxed on those profits. And when it pays the profits to the shareholders, it is again taxed on the shareholders' individual tax returns. And so there you go. There's where the term double taxation comes from. This is basically the biggest downfall for this particular entity. I would say, given all of the elements, this entity structure is probably not the ideal structure for a small business unless the small business is looking to go public or if they're seeking venture capital funding. Let's now move on to the S Corporation. The S Corporation is actually basically a C Corporation that has made an election to the IRS to be taxed as a pass-through entity. However, there are strict requirements in order to qualify for this particular tax status. One of the qualifications is that it must hold annual shareholders meetings and directors meetings. It must document the major key shareholders' decisions, and it's a lot of paperwork involved. The positive side, one of the advantages of this entity structure is that it does provide limited liability protection, and so that is a good thing. However, the disadvantage of this entity structure is that it is subject to the self-employment tax. However, there's a bit of a quirk with this, somewhat an advantage. It's only subject to 15.3% self-employment tax on what they call reasonable compensation. Now, your reasonable compensation is basically it's wages or salary, because this entity structure is considered an employee of the business. So the reasonable compensation that the business pays this person, which the salary is based on what this person could reasonably expect to be paid for their particular skill level if they were out there working in the marketplace, that is the portion that would be subject to the 15.3% self-employment tax. Now, this entity also distributes what they call dividends. And luckily, this portion of the distribution is not subject to the self-employment tax. So this particular entity does experience a slightly lighter tax burden than some of the other entity structures. Now that brings us to the LLC. The LLC, it's actually a favored tax treatment, and that's simply because it combines the elements of a sole proprietorship, a partnership, and a corporation. It does provide the liability protection of a corporation, while at the same time providing the tax treatment and the ease of administration of a sole proprietorship. So it kind of combines the best of all worlds. So that's why it's favored. This entity structure does report its profits on the individual tax return of the business owner, and they do pay the 15.3% self-employment tax. I believe that pretty much covers the elements I wanted to highlight today. And so I promised you something at the end. I told you that I would let you know which entity structure was best. And the answer is, it depends. It depends. Why? Because one size doesn't fit all. The best entity structure for you, your company, is really dependent upon your particular situation, your future goals of where you want to take your company, and those are some of the bases upon which would determine which entity structure was best. Now, your trusted tax advisor or CPA can help you, or should be able to help you to navigate through these complicated processes, and help guide you to let you know which entity structure would serve you best. However, if you don't have one, and if you would like for me to assist you, feel free to click on the link below to schedule your free strategy call, and I'd be more than happy to assist you. So, once again, don't forget to click on the subscribe button if you like this video, so you'll be notified when I upload new content, and I should be doing that very shortly. I thank you again for watching, and until next time, goodbye.